Every great operator knows this moment. The crowd leans in, the ticker flares with excitement, and the price surges through resistance like a bullet through glass. The amateurs cheer, certain that the market has broken out. But the professional does not chase. He waits. He watches. He tests. Richard Wyckoff called it the final exam of price, the testing phase, where the market reveals whether strength is genuine or merely a clever act by the composite man. Livermore understood this game better than anyone. The first breakout belongs to the public. The true breakout belongs to the patient trader who lets the market prove its story. Ladies and gentlemen, in every market cycle, there comes a moment that separates the professional from the public. The test. Prices surge through resistance, excitement fills the air, and the crowd rushes in, believing the breakout has begun. But the truth is, most breakouts are traps. They're not signals of strength, they're tests of character. Richard Wyckoff taught that before every genuine move, the market tests. It shakes out the weak hands, lures in the impatient, and measures the conviction behind every price. And Jesse Livermore lived by this rule: never trust a move until the market itself confirms it. Tonight, we're going to study that art, Wyckoff's testing rules, and learn how the masters separate illusion from truth, how they read the tape when the rest of the world is blind. Because in this business, the difference between success and failure isn't who predicts the breakout. It's who waits for the market to prove it. In the study of market behavior, few concepts carry as much weight or subtlety as the Wyckoff testing method. To the untrained eye, it appears as nothing more than a brief pause in price movement, a small dip, a hesitation, a flicker on the chart. But to the professional trader, it is the market's final exam, the moment when strength or weakness quietly reveals its true nature. Richard D. Wyckoff, one of Wall Street's great analysts of price and volume, observed that before every significant move, whether a powerful rally or a major decline, the market performs a test. The purpose of this test is simple: to determine whether supply or demand still dominates. A successful test confirms that the path is clear for the next move. A failed test exposes hidden resistance and warns of deception. In Wyckoff's view, the market is not a random creature. It behaves according to the motives of the composite operator, the large, informed interests who accumulate when the public sells and distribute when the public buys. When these professionals finish their accumulation, they often allow prices to dip slightly, testing whether any weak holders remain. If volume dries up and prices hold firm, it indicates that selling pressure has been absorbed. This is the successful test, the quiet signal that the stock is ready to rise. On the other hand, when a market breaks above resistance but then quickly fails, returning beneath it with heavy volume, that is the failed test. Evidence that the breakout was false, engineered to attract buying interest so that stronger hands could sell into demand. Wyckoff students learn to watch these moments with surgical precision. The quality of the test often foretold the destiny of the trend. Modern traders can still apply the Wyckoff testing method with remarkable accuracy. After a period of accumulation, look for a spring, a brief dip below support, followed by a rapid recovery on low volume. That low volume reaction shows the absence of selling pressure. Conversely, after a markup, a test of supply might appear as a minor rally that fails to expand on volume, a sign that demand is exhausted and distribution is underway. What makes Wyckoff's approach timeless is its focus on logic, not emotion. While the crowd is hypnotized by the breakout, the professional is watching what happens after it. The test reveals intent, it separates noise from signal. In essence, the Wyckoff testing method is not merely a chart pattern, it is a psychological mirror of the market's condition. It reminds traders that every true breakout must be proven, not assumed. To wait for that proof is to trade with discipline. To ignore it is to gamble with hope. In the world of trading, nothing seduces the public mind faster than a breakout. A sudden surge through resistance, a burst of volume, and the illusion of opportunity grips every novice trader's heart. But as Jesse Livermore warned, the market is designed to deceive most of the people most of the time. and that deception reaches its peak during the false breakout, when the crowd mistakes manipulation for momentum. To survive this trap, a trader must master the art of true breakout confirmation. True breakouts are not born from excitement, they are confirmed through evidence. Richard Wyckoff understood that price movement is a message, a reflection of supply and demand forces battling behind the curtain. When a market breaks through resistance, the professional does not buy immediately. He waits for the market to confirm its intention. He studies the reaction volume and follow through, searching for proof that demand truly outweighs supply. The hallmark of a true breakout is commitment, not by the public, but by the composite operator. When institutional interests have genuinely completed their accumulation, the breakout is steady, supported by volume that expands naturally, not erratically. The subsequent reaction, often a retest of the breakout zone, should show lighter volume and firm price support. This retest, or backing up to the edge of the creek, as Wyckoff described it, is where the truth reveals itself. If prices hold firm and rebound, it confirms strength. If they crumble back into the range, the supposed breakout was merely a lure. Volume plays a crucial role in this confirmation. In a genuine breakout, volume expands as price pierces resistance, then contracts on the pullback. This shows that strong hands are not selling aggressively. They are holding their positions, allowing the market to breathe. By contrast, a false breakout will often show heavy volume on the decline after the breakout, a sign that insiders are distributing while the public rushes in. Livermore's principle of waiting for confirmation aligns perfectly with Wyckoff's testing logic. Both men knew that premature action is the death of good trading. The market always offers a second chance. After confirmation, the professional mind understands that certainty is more valuable than early entry. To identify true breakout confirmation, a trader must train the eye to look beyond the obvious. The chart is not just a picture of price, it's a record of intentions. Observe how the market behaves once the excitement fades. True strength is calm, controlled, and consistent. False strength is loud, emotional, and fleeting. Ultimately, true breakout confirmation is less about predicting the move and more about proving it. The amateur reacts to the initial surge. The professional waits for the test. One trades emotion, the other evidence. And in that quiet distinction lies the very essence of successful speculation. Among the great market minds of the early 20th century, few contributed as profoundly to the art of speculation as Richard D. Wyckoff. His trading strategy was not a collection of mechanical rules or chart patterns. It was a living philosophy, a complete system for understanding how and why prices move. At its heart, the Richard Wyckoff Trading Strategy teaches traders to think and act like the composite operator, the invisible force representing the combined actions of the smartest, most well-capitalized players in the market. Wyckoff believed that price movement was not random chaos, but the visible expression of organized campaigns, phases of accumulation, markup, distribution, and markdown. Each phase reflected a deliberate process of buying and selling by professional interests. His genius lay in translating these invisible motives into recognizable footprints on the chart through the study of price, volume, and time. The Wyckoff strategy begins with accumulation, the phase where strong hands quietly absorb supply while the public remains indifferent. Price moves sideways, volume dries up, and volatility narrows. Then comes the markup phase, where the stock begins its advance as the composite operator allows prices to rise, triggering public attention. Later, after profits have been built, distribution occurs. Professionals sell into public enthusiasm, again leaving footprints of heavy volume and erratic swings. Finally, the markdown phase begins, where prices decline as the public is left holding inventory distributed by the professionals. What separates Wyckoff's method from most technical systems is its emphasis on intent. He urged traders to study the market as a detective studies a crime scene, to look for the motives behind every move. For example, an apparent breakout could be a trap, but if followed by a successful test's low volume, price stability, and renewed strength, it signals genuine demand. This alignment of context, structure, and confirmation is the essence of Wyckoff's trading logic. The Richard Wyckoff Trading Strategy is built upon three laws: the law of supply and demand, the law of cause and effect, and the law of effort versus result. These principles help traders measure whether a market move is logical or deceptive. If price moves sharply but volume does not confirm, the move is weak. If price holds firm despite light volume, it reveals absorption of supply, a sign of hidden strength. More than a trading method, Wyckoff's framework is a discipline of patience, observation, and psychological balance. It trains the trader to operate in harmony with market logic, not emotion. Like Jesse Livermore, Wyckoff understood that the real profit comes not from predicting the market, but from understanding it, from seeing what others miss in plain sight. In today's markets, where algorithms and headlines dominate, Wyckoff's trading strategy remains timeless. It reminds us that behind every chart, every candlestick, and every breakout lies a story, and those who can read it hold the real edge. Every trader knows the feeling: the surge of excitement as price bursts through resistance, the ticker flashing green, the market seemingly confirming your analysis. You buy, and moments later the market reverses, swiftly, mercilessly, leaving you with losses and confusion. This, in its purest form, is the false breakout, the oldest and most effective trap ever set by the market's invisible hand. To survive it, a trader must learn how to identify false breakouts before they do their damage. Richard D. Wyckoff taught that markets are governed by professional interests, the composite operator, who understand human behavior far better than the average trader. They know that the public equates movement with opportunity, so they use false breakouts to exploit that impulse, to sell into enthusiasm or buy into fear. Jesse Livermore, too, warned that the obvious move is usually wrong, for by the time it becomes obvious, the professionals have already acted. A false breakout typically occurs when price pierces a well-defined level of support or resistance, but fails to sustain movement beyond it. The key to identifying it lies not in the breakout itself, but in what happens afterward. Wyckoff emphasized the importance of testing, the market's way of verifying whether demand or supply is truly present. A true breakout will see volume confirmation, follow-through, and limited retracement. A false breakout, on the other hand, will show excessive volume on the breakout and immediate reversal, the telltale sign of distribution or absorption. To recognize a false breakout in real time, watch for three crucial elements. 1. Volume behavior. If the breakout occurs on abnormally high volume but fails to continue upward, it often signals that smart money is unloading positions into the surge of public buying. In contrast, genuine breakouts tend to show steady, proportional volume growth, not panic-driven spikes. 2. Follow-through failure. True strength sustains itself. If price breaks out, but then returns to the breakout level within a short period, especially closing back inside the prior range, it's a strong warning that the move was engineered to mislead. 3. Market context. Wyckoff always reminded traders to view the breakout within the larger structure. Is the market in an accumulation phase, or has it already advanced for months? False breakouts often occur at the end of distribution phases, when professionals are eager to offload inventory to late buyers. The best traders learn not to react to breakouts, but to observe their aftermath. A professional will let the market prove the move, waiting for a successful retest or test of supply. This patience transforms a potential trap into confirmation. In the end, identifying false breakouts is not merely a technical skill. It's a test of temperament. It requires the trader to see beyond excitement, to recognize manipulation as part of the market's rhythm. As Wyckoff wrote, "The market tells its story to those who will listen." False breakouts are simply the lies it tells to those who do not. Every great trading strategy eventually meets its true test, not in the market, but in the trader's mind. Charts, volume, and structure may guide your decisions, but it is your psychology that determines whether you can execute them with precision. The difference between amateurs and professionals is rarely knowledge. It is the control of emotion. This is the essence of professional trading psychology, the art of mastering yourself before mastering the market. Richard Wyckoff and Jesse Livermore both understood that speculation was not merely a financial pursuit, but a psychological discipline. The market is a reflection of human behavior, greed, fear, hope, and impatience repeating in endless cycles. The professional's edge lies in recognizing these emotions not only in others but in himself. The amateur reacts to the market, the professional responds to it. At the core of professional psychology is emotional neutrality, the ability to observe the market without bias or attachment. Wyckoff advised traders to study price and volume as evidence, not as justification for their beliefs. Livermore echoed this wisdom when he said, "A speculator must not be merely right, but right at the right time." That timing, he knew, depends on discipline, the strength to wait for confirmation, and the courage to act when proof arrives. Professional traders operate from probability, not prediction. They understand that no method is infallible, and losses are part of the business. When a trade fails, they do not feel defeated. They simply move on, for they know that the next opportunity will come. The amateur, however, personalizes every loss, allowing frustration to infect decision-making. This emotional volatility is what Wyckoff called the public's weakness, the inability to remain objective when the market tests one's conviction. Another cornerstone of professional psychology is patience, the willingness to wait for the market to align with your setup. Wyckoff's entire methodology rests on waiting for the test, the moment when the market confirms its true direction. This patience is what allows professionals to avoid false signals and trade in harmony with the dominant force of supply and demand. Livermore himself often said his greatest profits came not from buying or selling, but from waiting. Professional traders also cultivate detachment from outcome. They focus on process, not results. Each trade is executed according to a plan, managed by risk and evaluated by logic, not emotion. Success to them is not a single profitable trade, but the consistent execution of sound principles over time. In truth, the market rewards psychological maturity more than analytical brilliance. Systems can be copied, indicators can be learned, but emotional mastery cannot be borrowed. It must be earned through failure, reflection, and discipline. Professional trading psychology is not about conquering the market, it is about conquering yourself. For once you master your emotions, you no longer trade against the crowd, you trade against your own weakness. And that, as both Wyckoff and Livermore knew, is where real consistency begins. In the end, every market, every ticker, every chart, every so-called setup is nothing more than a reflection of human behavior. Prices rise and fall not because of magic or mystery, but because of the eternal forces of supply and demand, guided by the invisible hand of the composite operator. Richard Wyckoff devoted his life to teaching traders how to see beneath the surface, to read the market as a living organism with intent and rhythm. The Wyckoff Testing Method reminds us that every move must be proven. The true Breakout Confirmation shows us that real strength is revealed only through evidence, not excitement. The Wyckoff Trading Strategy gives us structure, a logical map to navigate the endless cycles of accumulation and distribution. And the skill of identifying false breakouts protects us from the market's most cunning deception, the illusion of opportunity that traps the impatient. But all of these tools, all of this analysis, mean nothing without the final and greatest discipline, professional trading psychology, because no strategy can survive a reckless mind. The market will always test your patience, your fear, your greed, and your ego. The professional passes that test not by predicting the market, but by mastering himself within it. Wyckoff and Livermore both understood this universal truth. The market rewards observation, not emotion. It punishes haste and honors patience. It humbles the dreamers but elevates the disciplined. And though the tools may evolve, the principle never changes. The market tells its story to those who know how to listen. So as you stand before your charts, remember this: the market does not move against you or for you. It simply moves according to law, the law of cause and effect, of effort and result. Your task is not to control it, but to understand it. And when you can see through the illusion, when you can wait for the test, confirm the breakout, and trade with calm precision, then, and only then, you step into the ranks of the true professionals. Not gamblers, not followers, but students of truth in motion. That is the essence of Wyckoff's wisdom. That is the art of speculation. And that will always be the difference between the 90% who fail and the few who endure.